Most people think having money in the bank makes you the perfect customer. Responsible, predictable, low risk. But here's the twist that almost nobody talks about. Once you quietly build up around $20,000 in savings, something changes. You stop being just another customer, and you start becoming a problem. Not because you're doing anything wrong, but because you're doing something very right. And in a system designed around debt, discipline can be surprisingly disruptive. To understand this, you have to look at how banks actually make money. It's easy to assume they profit from holding your savings, like a digital vault charging rent. But that's not how the system works. Banks generate revenue by lending money, not by storing it. Your deposits are fuel. They use that money to issue credit cards, auto loans, mortgages, and personal loans at significantly higher interest rates than what they pay you. If your savings account is earning 0.5% APY while they're lending at 7%, 12%, or even 20%, that spread is where the real business happens. Now, here's where it gets interesting. Someone with a few $100s in savings is statistically more likely to rely on credit. Unexpected car repair? Swipe the card. Medical bill? Payment plan. Vacation? Financing. That person becomes highly profitable because they're paying interest, fees, and sometimes penalties. Their financial instability feeds the system. But once you reach a cushion like $20,000, you start behaving differently. Emergencies don't force you into debt. You don't need to carry a balance on your credit card. You're no longer dependent on high-interest products. From the bank's perspective, you're slipping out of the most profitable category. That $20,000 mark is psychologically powerful. It represents control. It means you can cover several months of living expenses, maybe even a year depending on your lifestyle. Financial advisors often call this an emergency fund, but in reality, it's more than that. It's leverage. With that kind of buffer, you can walk away from a bad job, avoid predatory loans, and negotiate better financial terms. You're not reacting anymore. You're choosing. And that shift from reactive to proactive is exactly what reduces your value to a system that thrives on urgency and dependence.
There's also a behavioral layer to this. Once someone proves they can save $20,000, they've developed habits that banks can't easily monetize. Discipline, delayed gratification, and long-term thinking don't generate late fees. They don't rack up revolving credit balances. Instead, these individuals often start asking different questions. Why am I paying 18% APR on this credit card? Should I refinance this loan? Could I invest this money instead of letting it sit in a low-yield account? That curiosity leads people away from high-margin banking products and toward wealth-building strategies like index funds, retirement accounts like a 401k, or even direct brokerage investing. And when customers start moving money out of traditional savings and into investments, banks lose even more control. That's because invested money isn't sitting in their system to be leveraged. It's working somewhere else, often in markets that don't directly benefit the bank's lending operations. Even worse, financially aware customers tend to shop around. They compare interest rates, avoid unnecessary fees, and use tools to optimize their finances. They might maintain a high FICO score, not to borrow more, but to access the best terms only when necessary. That makes them selective borrowers instead of consistent revenue generators. There's also the issue of predictability. Banks rely heavily on behavioral patterns. Algorithms analyze spending, borrowing, and repayment habits to forecast profitability. A customer living paycheck to paycheck with recurring debt is highly predictable, but someone with significant savings introduces uncertainty. They might pay off a loan early, reducing interest income. They might avoid borrowing altogether. They might even shift to institutions offering better yields or lower fees. In short, they're harder to model and less reliable from a profit standpoint. This doesn't mean banks literally fear individuals with $20,000 saved in a dramatic sense. It's not personal, it's structural. The system is optimized for a certain type of financial behavior, and once you move beyond that, you no longer fit neatly into the model. You become less profitable, less dependent, and more autonomous. And autonomy is the one thing the financial system doesn't incentivize, even though it publicly encourages saving.
Ironically, banks still market heavily towards savers. High-yield savings accounts, sign-up bonuses, and promotional rates are designed to attract deposits. But these offers often come with conditions, limits, or temporary benefits. The goal isn't just to reward saving, it's to keep your money within their ecosystem, where it can be used for lending. The real shift happens when savers start asking what their money could do outside of that system. At $20,000, you're standing at a crossroads. You can leave that money parked, slowly losing value to inflation, or you can start using it strategically. That might mean building a diversified portfolio, contributing to tax-advantaged accounts, or even exploring opportunities like real estate or entrepreneurship. The key difference is that you're no longer just protecting your money, you're positioning it to grow. And that's the quiet truth behind the headline. Banks don't fear people with $20,000 saved because of the number itself. They fear what it represents: independence, awareness, and choice. When you reach that level, you're no longer playing defense. You're starting to play offense with your finances. You're less likely to fall into debt traps, less likely to pay unnecessary fees, and more likely to build real wealth over time. So if you're approaching that milestone or already there, recognize what it actually means. It's not just a safety net, it's a turning point. The moment where you stop being just a participant in the system and start becoming someone who understands how to navigate it.